Hi everyone. In this video, I'm going to discuss the financial reporting assumptions that underlie how we account for financial transactions. And there's going to be 4 of them that we talk about, and here they are. First up, monetary unit assumption. Underlying all of accounting is that financial transactions or financial information can be expressed in terms of currency. So financial information can be expressed as currency. And notice I'm not saying US dollar. It often is, say, US dollar. But it can be an international currency as well. Heck, depending on the company, maybe even they could get away with a cryptocurrency, though in today's world that's probably a little less likely. But the monetary unit assumption simply says if we're accounting for something, then we have to be able to express that something in terms of a currency. Okay? Next up is economic entity assumption. Economic entity assumption simply says that all parties to financial transactions are separable from each other. All right, what do I mean by that? All parties to financial transactions are separable from each other. Well, it means that they are their own entities. And since this is financial transactions, they are their own economic entities. So if you have company A doing a financial transaction with company B, then company A's side of the transaction and impact to company A is separable from company B's side of the transaction and the impact to company B. Company A will report their impact on their financials. Company B will report their impact on their financials. They are their own economic entities. The same concept can apply within an organization. Let's say you have the company and the company is writing a paycheck to its CEO, right? The company's financials and the impact of that paycheck, in other words, money going out, are recordable and reportable by the company. The CEO's financial situation and impact from that transaction, that is recorded and reported in whatever way the CEO personally tracks his own finances. But they are not commingled in any way, right? 2 separate parties to a transaction, separable economic entities that can record and report on their side of the transaction independently of the other. That's the idea of the economic entity assumption. Next up is the periodicity assumption. Periodicity, it's a tough word to say, assumption simply says that time can be artificially divided into periods of financial activity. All right, so what do we mean by this? Well, if you think about the concept of time, and we're going to get really, beyond the scope of accounting for just a minute. If you think about the concept of time, it is an ongoing, never-ending, no pausing, no stopping type of thing. Time is time. Time just goes. But from an accounting standpoint, that's a really hard concept to deal with because you have transactions and then some time passes and you have more transactions and some time passes and you have to ask yourself, well, when do you prepare a financial statement? Do you do it after a week? Do you do it after a month? Do you do it when the company goes out of business? Do you wait until time hits the end of time in all the universe? Like, when do you actually stop and say, here was the financial activity? And so we break time up into artificial buckets. We do this in our just everyday lives. This is not just an accounting thing. We break time into months, weeks, days, hours, minutes, seconds. We all live by these artificial breakdowns of what represents time. And for financial reporting purposes, it's no different. We assume time can be broken into artificial periods, and we have a start and a stop to each of these periods. It might be a quarter, it might be a year, it might be even as little as, say, a month if you're doing some sort of internal reporting. And you artificially divide time into these periods, and then you record and report on the financial activity within each given period. All right, that's periodicity assumption. And the last up is the going concern assumption. And going concern assumption, the simplest way to say this is it is the assumption that companies live forever. And this is especially true of publicly traded companies, right? Publicly traded companies' lives are not tied to the owners. They are their own entity. And if owners lose interest or otherwise pass away or whatever the case may be, the stock that was in those owners' possessions will somehow get transferred to another owner that is interested in the company. And so the company will continue to survive as long as the company remains financially viable. Okay? So the assumption is companies live forever. Now, we know that that's not true. Companies do go bankrupt, they go out of business. But why do we make this assumption? Well, here's the deal. Have you ever seen a company that is going out of business? You can usually tell. One, they usually show up in the media quite a bit. Two, they get these big neon signs and banners that go all over their stores. Going out of business sale. Everything must go. Everything's 75% off, right? And those are what we call going out of business prices. And the thing is, going out of business prices do not reflect true market value of items. And so if we were to assume companies don't live forever, if we were going to assume that companies die, we would have to assess how close are you to death, and we might have to value the company at a going out of business price. But we don't want to do that because companies don't have a predetermined endpoint. Companies, for all intents and purposes, can live forever if they stay financially viable, and therefore we should value them as if they are just operating at current market rate. And so that's the idea of the going concern assumption. We assume the company lives forever. That way we don't have to value it at a going out of business price, an unrealistic below market valuation. So that's it. 4 assumptions. Some of them kind of seem intuitive. Some of them it's obvious, like, okay, this is why it matters for accounting. But the idea here is for accounting to operate, for it to function in a consistent way, you need to kind of make these assumptions. You need to assume the parties are separable. You need to assume everything has a currency value. You need to assume that you can do artificial periods. You need to assume the company is not about to go out of business. By making these assumptions, you can account in a way that is reliable and in a way that's comparable, in a way that makes accounting information useful to investors. That's it for financial reporting assumptions. Hope you found this helpful, and I hope you join me for another video.